Hello, it's Monday, the 3rd of June. I thought we'd pause for a few moments and just reflect on what's been going on in markets. I was away last week, luckily enough to be on holiday in France, and I experienced something that I thought we could reflect on, namely a bit of sterling strength. You may not really have sort of appreciated it because it's sort of happened in quite a gradual way, but over the course of the last couple of years, sterling's appreciated pretty meaningfully, albeit from a low base, against a number of its major trading partner currencies. So taking the euro as a case in point, back in 2020, sterling was getting close to parity or 1-to-1 in a ratio with the euro. Never quite got there, but it got very close. And as of today, it's in the sort of 117. So, in round numbers, a sort of 17% increase in purchasing power for sterling-based spenders in the Eurozone over that period. Now, still some way, of course, from the sort of pre-Brexit 2016 highs of the 1.4, but actually that sort of gradual accretion in spending power may have passed many of us by. Now, it's not just against the euro. Actually, the reason I mention it is because as of last week, sterling hit an 8-year high against a basket of its currencies on a trade-rated basis. Sterling actually hit an 8-year high. So it's interesting, we experienced it. You sort of saw it when the bill came, and when you translated it back into sterling, it wasn't quite as bad as it would have been a couple of years ago. But actually, it's symptomatic of a bigger factor here, which is that sterling's been doing fairly well against other currencies over the last couple of years from that sort of low base in 2020. When we think about currency management in our funds and portfolios, we tend to leave the currencies unhedged. We leave that currency risk open for the equity allocation within the portfolios and the funds, but we hedge it out in the fixed income portion of the funds. The thing to think about when it comes to currency management, when you're investing overseas, it will either boost or sort of enhance your returns if the foreign currency appreciates against sterling. But on the other hand, if it depreciates against sterling, it will reduce the value of your foreign currency returns when translated into sterling terms. It's called a translation effect, and it's something that we allow to happen on the equity side of the portfolio, and we remove it from the fixed income. And the main reason for that is quite simply on the equity side. The volatility that currencies introduce, we believe, is sort of less impactful to the overall portfolio construction experience from equities, which are already a relatively volatile asset class. Whereas fixed income, you're sort of diversifying asset class, generally a lot lower volatility than your equity exposure. We think that the currency translation volatility that brings is more significant than the sort of volatility from the asset class. And as a result of that, it sort of taints the overall experience that you get from global fixed income if you leave it unhedged. Other things that's been going on, obviously, as we're in the start of June, we've finished May. We can reflect very quickly on what happened in markets overall. It's fair to say that May was a better month coming on the back of a slightly sort of damp squib of April. May saw markets sort of generally sort of drift up a few percentage points, two or three, depending on where you're looking. Quite interesting to see in the UK, small companies is actually performing substantially better than larger companies, and mid-cap sitting somewhere in the middle. And then more generally, if you look at the Northern Hemisphere, over the last 6 months or so, we've got sort of returns from most markets very firmly in the double-digit space, which is a good result over 6 months, of course. And I suppose when you think about where they started in that November point in 2023, where we had a period of pretty significant nervousness around inflation and interest rate policy in the tail end of last year, that abated through December and has generally, despite a few wobbles on the way, remained the sort of theme in play through the course of 2024. Less worries about inflation on the whole than we saw in that sort of period in the sort of autumn of 2023. We can't really reflect on the last couple of weeks without referring to politics, most notably, of course, the surprise announcement of a general election impending in the UK in what is now about 5 weeks' time, of course. The need for a general election was a known, and so the surprise is more around the timing rather than the fact of it. And if you look at what markets did over the period of the announcement and subsequently, you'll see there hasn't really been much of a sort of impact on markets. So it really was sort of taken in its stride and in that sense. Now, needless to say, over the next few weeks, we'll get lots of what we think of as noise lots of sort of politics in the background, doesn't necessarily impact fundamentals of markets. And so it might be a source of volatility, but short-term volatility rather than sort of meaningfully altering the long-term path of markets. We've got lots of news coming up over the next few weeks. We've got more data. We've got interest rate decisions. We've got the ECB decision coming up on Thursday. It's widely expected to be a 25 basis points cut. It's pretty much nailed on in terms of market pricing. But there's still a possibility, of course, that doesn't happen. So we'll reflect on that as we get to the end of the week. That's it for me. Thank you very much, and we'll see you next time.